In this video, I'll tell you why I still won't be buying Starbucks even if it's down 30% of the highs. The future looks great for Starbucks as they pledge to buy back shares and new dividends over the next 3 years. But again, until it's reflected in their financials, nothing is set. SBUX is currently trading at $89.6 with highest price of $126.32. That's 29.07% of the highs. Current market cap of $103.07 billion with PE ratio of 24.17. They give out an annual dividend of $1.96 per share, a yield of 2.19% of the current price. First metric, we want an EPS multiple lower than 3. It's 6.53. EPS multiple is PE divided by the EPS. PE is the price we pay for in a stock. Stock price is just an agreement between the market participants on how they value the company at that time. It's expensive, but is it worth paying for? EPS is increasing because their OSN is decreasing, which is good. If you're in it for the dividends, it's safe at 52.97% of their current earnings. They're buying back shares. That's good. But we don't want companies to be buying back shares if the stock price is expensive. But if they think it's undervalued, of course they'd buy back shares. Next metric, we want to pay $1 or less for 1% of the money they're making. Meaning, we want to pay 1 PE or less for 1% of their net income or free cash flow margins, whichever is the lowest. This is revenues they constructed, the costs and expenses the company uses to make these revenues. Net income is after taxes, and free cash flow they generate off of those revenues. The above values are in billions. Below are in percentages of their respective revenues, or as they would call it, yields or margins. I'll show you the relationship of the cells. Of the 4 highlighted values, we'll use the lowest one to divide the current PE. But I won't be using 12.63 here because look at 2020, that's an anomaly. So instead, I'm going to be using 14.45 to divide the current PE. And we'd get a premium of 1.67. This means the stock is trading at overvalued prices. But later, we'll check on my multiples for growth to kind of see where SBUX is trading now. But with this revenue growth of single digits, I won't pay premium for the stock. Third metric, we want to know our discount compared to when the markets have valued the stock before by looking at their historical PEs. I took this data from Guru Focus and Macro Trends. We'll take the lowest PE to divide the current PE and we'll get a discount of 0.95. This means the stock is trading at a lower PE now. In conclusion, the stock is overvalued as it trades 6.53 times their earnings, 1.67 times their yields. I don't own the stock. Personally, I don't buy stocks at a premium, but I'll share with you my growth assumptions. The fair value of the stock based on the current EPS in my first metric of 3.7 multiplied by the lowest yield in my second metric, which is 14.45. I think the fair value is $54. Here are my discounted entry PEs, 10, 12, 14. If we look back here, look at these yields. I think 10, 12, 14 is very reasonable with a little bit of margin of safety. Just a little bit. And here are the prices for those PEs. If we multiply these PEs by the current EPS. By my multiples of 1.25, 1.5, 1.75 for 10-20% growth in EPS, it is currently trading at 30% growth in EPS. That 1.75 here. So I think the market is betting on Starbucks that it will grow 30% sometime in the future. But these numbers, guys, this is assuming that they will still have the same yields or margins over the next few years because, here, 10, 12, 14. Remember, 1 PE, I pay 1 PE for 1% of their margins. I don't bet in the future. That's why I don't buy stocks at a premium. I buy them at reasonable discounted prices. I like when the markets are undervaluing them because that's the time to be loading up more. This one I'd stay away from until there's an increase in their margins or, the stock plummets and everything looks reasonable. Looking at their charts, my fair value price is 54. That is COVID low. I don't think we'll see those lows again. Maybe, when they disappoint earnings. It's just crazy to me that everything the stock market went up when everything in their financial crumbled. It does make sense. For now, I'd put this stock in my avoid list. This three metric I use is designed to determine the best PE to buy a particular stock, as I believe PE is the price we pay for in a company. This is my process of screening stocks to buy at what PE by looking purely at the company's financials and none of their fundamentals. If you like to invest in these companies, I'd advise you to look at their fundamentals, their charts, and more of their financial data and metrics like long-term debt, some important financial ratio, etc. As always, do your own research.